Hi, welcome to Chapter 3. In Chapter 3, we will be learning the adjusting process. So what we have been doing is making journal entries, daily journal entries, and it was likely that something triggered us to make these journal entries. For example, we may have received cash or we may have earned revenue. But in the adjusting process, at the end of the month, we ask ourselves, is there anything that needs to be adjusted that we have not updated yet? For example, has some supplies been used up? Has some prepaid insurance been used up that we need to adjust? So that is how our adjusting process will be. So take a few minutes and look through our objectives, which we will be learning. And then at the end, go back and look at these objectives and make sure you understand all of the objectives. So first, we're going to be looking at the difference between cash basis accounting and accrual basis accounting. So first, I want to tell you that small companies can use cash basis accounting, but companies that are publicly traded have to use the accrual basis of accounting. So everything that we will be learning in this chapter will be based on the accrual method. Okay, so cash basis means that you record the revenue when cash is received. In an accrual basis, you record revenue when you earn them, so it doesn't matter if you've been paid cash yet. You would just put that into accounts receivable. For cash basis, expenses are recorded when cash is paid. But for accrual basis, expenses are recorded when they're incurred or when you have received the benefit of the expenditure. It doesn't matter if you haven't paid it. If you haven't paid it yet, you just put it into accounts payable. If you haven't received it yet for revenue, you put it in accounts receivable. Okay, so under GAAP, you can't use cash basis, but not all companies are subject to GAAP. Not everybody uses generally accepted accounting principles, so it's fine for companies to use cash basis if they are not subject to GAAP. Accrual basis is used by most businesses, mainly larger businesses, and definitely those businesses that are publicly traded. The cash basis method is easier to follow because it requires less knowledge of accounting concepts and principles. But accrual basis provides a better picture of a business's revenue and expenses because revenues are recorded when they're earned and expenses are recorded when they are incurred. Okay, so this is an example to show you the difference. On May 1st, Smart Touch Learning paid $1,200 for insurance for the next 6 months. So if you were cash basis, you would go ahead and show that you had expenses of $1,200 for that month, which would put a big expense into 1 month. But if you were accrual basis, you would put that expenditure into an asset called prepaid. And then you would show it to be expensed for $200 every month until it got used up. So in that way, you are spreading the expenses out into the months that it covered you. So it's a better picture of what happened. Again, we have to make an entry for that $1,200. So we know that we have to credit cash for the $1,200, but it's a matter of recording all the expense in 1 month or recording it as a prepaid in the first month and then expensing some of it each month. Either way, we will expense $1,200, but the way that we expense it is different, as you can see, from the cash basis and the accrual basis. Okay, on April 30th, Smart Touch Learning received $600 for services to be performed for the next 6 months. If you were cash basis, you would show all that up front as revenue. But in actuality, you haven't earned it. Under accrual basis, you would still record all of it in cash, but you would record it as a liability. And then you would record it as revenue over the next 6 months as you earned it. so that each month shows the actual earning that you did. Define and apply the time period concept, revenue recognition, and matching principles. The time period concept assumes that business activities are sliced into small time segments, like those months that you just saw. So we prepare financial statements by month or by quarter or by year, or all of the above. A fiscal year is an accounting year of any 12 consecutive months. Although they often have a year end of 12/31, they don't have to end at December 31. Some companies end at June 30th. So we call that a fiscal year. It's the 12 months that that company chooses to report on. The revenue recognition principle tells a company to record revenue by a 5-step process. First, you identify the contract with the customer. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Step 2, identify the performance obligations in the contract. So what are the promises with the customer to transfer the goods or service? Then determine the transaction price. That's the amount that the entity expects to be entitled to as a result of transferring goods or services. Step 4, allocate the transaction price to the performance obligations. So if you have multiple performance obligations, the transaction price will need to be allocated among the different performance obligations. Then you recognize the revenue as the entity satisfies each performance obligation. So if you look at it as magazine subscriptions and that somebody pays you up front for these magazine subscriptions, each time you send a magazine, you will have performed part of the obligation. So if the customer paid you for 12 magazines up front, you would record revenue, 1/12 of the revenue each time you sent a magazine. The matching principle guides accounting for expenses and ensures all expenses are recorded when they are incurred during the period and that expenses are matched against the revenues of the period. So we're trying to match revenues and expenses in the period that the expense helped you earn the revenue. Let me give you an example. Say you have a grocery store and you pay your employees at the end of the month. They actually helped you make that revenue at all different times. So making sure that any hours worked get put into the same month that it helped you earn that revenue, that they helped you earn that revenue, that is an example of matching the expense with the revenue. Another example, a car lot. Let's say that you open up a brand new car lot. You buy 30 cars to sell. On day 1, you've got a big cash outlay for those cars, but you haven't sold any yet. So if your month ended at that point, it would look like you had a huge loss and no revenue. But in actuality, if you match the cost of the car at the same moment that you made the sale, then you've got a better picture. Let's say in the second month you sold a car. At that point, you could expense the cost of that car sold to you. Sorry, you expense the cost of that car to you. When you make the sale, you expense it. Now you have matched the expense of the car in the same period with the sale of the car. So what you do is you keep it as an asset called inventory, and then every time you sell a car, you move it out of inventory and into cost of goods sold, which is an expense. So I like to think of it as most assets get turned into expenses, and it just matters when. And the when is the period in which they helped you earn the revenue. Alright, so now we're going to talk about journalizing and posting the adjusting entries. So we start with the unadjusted trial balance. That's the trial balance after you made your daily transactions. But they don't show the whole picture. Certain entries need to be updated. So you might have some revenue that needs to be shown, or some unearned revenue that's now been earned. So we're going to update for those. These are the adjusting entries. We're going to update an asset and a liability account, and they're going to be broken down into two categories: deferrals and accruals. Deferrals defer the recognition of revenue or expense to a date after the cash is received. We have two types of deferrals: deferred expenses and deferred revenues. Let me give you an example. For example, if we had a deferred expense, it's like supplies. Remember when we purchased supplies, we debited supplies and we credited cash. We were deferring the expense of the supplies until we used them up. So now in this chapter, once we use them up, we will move them out of supplies into expense. So that was a deferral. Deferred revenues. If you receive money for services you haven't performed yet, you put it in unearned. That's deferred revenue. That means that you defer the revenue until you earn it. Okay, accruals are easier. Accrued expense means you just record the expense, but you haven't paid it yet. So it will always include a payable. Accrued revenue means that you have earned the revenue, but you have not received cash yet. So you record revenue, but you haven't received the money yet, so it will always include a receivable. Always include a payable for expense, and always include a receivable for revenue. So we have not paid any cash here, and we have not received any cash here. So I say accruals are easier because they're either a payable or a receivable. Okay, here are some more examples. Deferred expenses or advanced payments of future expenses. They're also called prepaid expenses. They're treated as assets until they get used up. And then once they get used up, they are put on as expenses by the adjusting journal entry. Types of deferred expenses include, the example that I gave you was office supplies, also prepaid rent, and depreciation, which we will be talking about. Okay, so here's how it works. Smart Touch Learning prepaid 3 months office rent of $3,000 on December 1st, 2018. This is a deferred expense. So on December 1, they debit prepaid rent and they credit cash. Now this is not an adjusting entry. An adjusting entry will never involve cash. This is just a regular entry. They made the payment. However, they couldn't put it to rent expense because this is going to benefit them in the future. So they deferred it by putting it into this asset account, prepaid rent. Then at the end of the month, they needed to move $1,000 that has been used up. So as you can see, at the end of the month, they needed to move $1,000 out of the asset account, prepaid rent, and into rent expense. So we move it out of the asset, we credit prepaid rent, and we put it into the expense by debiting rent expense, because time has gone by and 1 month has been used up. At this point in time, they had $3,000 in prepaid rent. 1 month has gone by, so now there is a balance in prepaid rent of $2,000. 3,000 minus 1 is 2. So now the ending balance is $2,000. Another example, office supplies. We purchased office supplies on account. So we put $500 in office supplies. Then at the end of the month, we count up our office supplies to see what is remaining. We have $100 remaining. So what happened? We had 500 and now we're down to 100. What happened is we used up 400 of them. So now we need to move $400 out of office supplies into supplies expense. That's the adjusting entry to update our supplies. So we'll debit supplies expense and credit office supplies, and that will get our balance down to the correct $100. All right, depreciation. So we have long-lived assets, often referred to as property, plant, and equipment. And we put them on our books at cost. But that cost gets allocated over periods, called depreciation. And that's how it eventually gets expensed. So the adjusting entry will be the cost allocation to depreciation expense. So to calculate depreciation, we're going to use what we call the straight line method. You're going to say the cost of the asset minus the amount of value remaining at the end of its life. If you thought you were going to sell it at the end for $2,000, then you would take out $2,000 of residual value, and then you would divide by useful life. And they'll tell you what the useful life is. Typically for computers, it's 3 years. For equipment, it's 7 years. For buildings, it's much longer, but there are set amounts for useful life. Okay, so here we have furniture. So $18,000 in exchange for capital. So this is the purchase of furniture, and they gave Bright some capital for it. So we would debit furniture and credit Bright capital. Right, so now we're at the entry where we're going to depreciate it. We believe it will last 5 years and have a residual value of $0. So we say 18,000 divided by 5, and we find out that we're going to depreciate it 3,600 each year, and divide that by 12 to get 300 per month. So every month we're going to depreciate it by 300. So the good news is that depreciation entry will always look like this: debit depreciation expense and credit accumulated depreciation. So what is accumulated depreciation? Accumulated depreciation is the account that has all the depreciation expense to date. It is an ongoing depreciation account, so you can always look at it and see how much depreciation has accumulated on this asset. So accumulated depreciation is what we call a contra asset account. So what that means is it's an asset, but it works the opposite of an asset. The word contra just means against. In other words, it goes against the equipment. So if you were to look at equipment, you would see that equipment we bought it, the furniture, for $18,000. Then right below the equipment account, you would find the account titled Accumulated Depreciation, and more precisely titled Accumulated Depreciation Furniture. And it would have a credit balance of $300. So a debit of your furniture and a credit of accumulated depreciation, those two accounts would get netted together. One has a debit balance and one has a credit balance. So the net book value of the equipment right now is $17,700, net the $18,000 with the $300. So it can always tell you what the book value is by taking the asset minus the accumulated depreciation. Okay, so it is paired with and is listed immediately after it's a related account. So it would show furniture, and right below it, it would show accumulated depreciation dash furniture. So they're always right there next to each other. And then a contra account's normal balance is the opposite of the normal balance of the related account. So furniture's normal balance is a debit. So accumulated depreciation's normal balance is a credit. Okay, so here's a visual for you. This is our furniture account with its normal debit balance. And this is our accumulated depreciation furniture and its normal credit balance. So to find our book value, we would say our $18,000 minus our accumulated depreciation of $300 would give us $17,700. So let's talk about where that depreciation expense went. Depreciation expense, that gets recorded on your income statement and it reduces your net income. Since when we bought that furniture, we didn't reduce any net income for it because this building that we bought is going to benefit us for many years. So we'll just slowly depreciate it and lower income slowly over time for that. So this is what the balance sheet would look like for this. So we have land. It doesn't depreciate, so we just leave it on the balance sheet at cost. Building minus its accumulated depreciation, and furniture minus its accumulated depreciation. And then you get to property, plant, and equipment net. That means net of its accumulated depreciation. All right, deferred revenues. So when a company receives cash before it does the work, so when you have an unearned, it's a liability because you owe them the work. So once you perform the work, we move it or convert it to revenue. So we take it from the liability and move it to the revenue. Let's look at an example. On December 21st, the law firm engages Smart Touch Learning to provide e-learning services for the next 30 days, paying $600 in advance. We got the cash, so we can debit cash for $600, but we can't call it revenue yet because we haven't done the work. So we put it into this liability account called unearned revenue. Then during the last 10 days of the month, we will earn 1/3 of the revenue. So we will move 1/3 of the revenue out of unearned revenue. So we decrease a liability with a debit, and we will put it into service revenue for the portion of revenue earned. Remember, we increase revenue with a credit. Accrued expenses, remember this just means payables. So we pay our employees' salaries half on the 15th and half on the first day of the next month. These are our pay dates. So during December, the company paid the first half month's salary on Saturday, December 15th and made this entry. Okay, so we paid it on that date. Then at the end of the period on December 31st, we need to prepare financial statements. So we need to show how much the employees have worked since the last time we paid them. We're not going to pay them yet. We can look at the calendar and see that they have worked, how many days they have worked since the last time they have gotten paid, but they're not technically going to get paid until January the 1st. So we need to show on the date that we run our financial statements, December 31st, that we have incurred an expense and we're going to pay them at a later date, January the 1st, the next day. So we would debit salaries expense for $1,200 and credit salary payable for $1,200. And that is an accrual. All right, the next day that we pay them, we just get rid of our payable, debit payable, salaries payable for $1,200. and we credit cash because we pay them the next day. Interest expense would work the same way. We purchased a $60,000 building in exchange for a 1-year loan on December 1st. So on the day that we buy the building, we debit building and credit notes payable for $60,000. To compute the interest, we say principal times interest rate times time. So that would be 60,000 times 2% times 1/12 because we're only going to get 1 month of interest. And the reason it's 1/12 is the interest rate that we're given is always given as an annual interest rate. So to get it to 1 month, we just take it times 1/12, or however many months we're trying to accrue for. So we would debit interest expense and credit interest payable for $100. Remember, I told you that an accrual always involves a payable. Let me clarify that. Accrued expenses always involve a payable. And as you can see here, we have a payable in our adjusting entry, in our accrual entry. And then once we pay it, we will take it out of this payable and debit the payable and credit cash. All right, accrued revenues will always involve a receivable. So we have performed a service, but we haven't gotten paid the cash yet. So it will be a debit to accounts receivable and a credit to service revenue, because we have not done the work. So here it is, debit accounts receivable and credit service revenue. This is just showing you how it would increase accounts receivable. There's your debit, there's your credit. Once we receive the money, we will debit cash, and in this case we've earned some more, and then we would credit accounts receivable. Okay, rules to remember. Adjusting entries never involve the cash account. They're updating something other than cash. Adjusting entries always increase a revenue account or increase an expense account. And they always involve an income statement and a balance sheet account. All right, this is a good summary. A through D are deferred expenses. E represents deferred revenue. F and G are accrued expenses, and H is an accrued revenue. So you might want to print this out and take a look at it, or so you can practice it, or just make you a copy of this, but make sure that you understand these journal entries. All right, now after we prepared our daily transactions, our daily journal entries, we prepared a trial balance, an unadjusted trial balance. And then after we make our adjusting entries and post those to our ledger, we will prepare an adjusted trial balance. Okay, so the process is always journalize, post, trial balance. But since we're in the adjusting process, we are journalize adjusting, post adjusting entries, and prepare the adjusted trial balance. Okay, so here's the adjusted trial balance, and you can tell that we have some new accounts. The first ones you may notice is your accumulated depreciation accounts. We also have some interest payable that we've put on. And then we have a salary payable that we put on, and etc. All right, the impact of adjusting entries on the financial statements. So if we didn't record adjusting entries, our financial statements would be incorrect. We would be missing information. We might have expenses that should be there, but they weren't. We might have unearned revenue that should have been earned. And this is a good table that will explain what will happen if you leave off an adjusting entry. All right, so let's look at this worksheet. The worksheet is a tool that helps accountants. So it has a list of your account names and it's still in the same order. So you have your assets and then you have your liabilities. And then you have your owner's equity, your revenues, your expenses. Okay, so they're still listed in the trial balance format. So here's your unadjusted trial balance. It's still in balance. And then these are your adjustments. So let me show you how this works. Let's find letter A for 1,000. So it's in the debit column. We debited rent expense for 1,000. And then here is the A that matches it in the credit column. So we credited prepaid rent. So obviously some time went by and we used up some rent. So we took it out of prepaid rent and put it into rent expense. So the purpose of the worksheet is to see what exactly did that do to the balances. So let's just look at accounts receivable had 1,000 and then the adjusting entry made it go up to 1,800. So now my new balance in accounts receivable is $1,800. So the accountant would say, yeah, that's what I expected that to be. Yep. And then office supplies, we had 500. We adjusted for 400. So now we have 100 left. And I know that that number's right. I counted it up in the supplies closet so I can look at this and say, yep, that one is right. Prepaid rent, I have 3,000. 1 month went by, so now I have 2,000 left in prepaid rent. And then you see land, it never gets adjusted because it never depreciates. And then you can see that building never gets adjusted because that is done in accumulated depreciation. So you can see that our building did depreciate a little bit, $250 of depreciation. So it just lets you look at it like this and you get to see all the accounts and the full picture and the impact of the adjusting entries. Okay, this may make some of you happy, but we are actually not going to cover the appendix, but you can look at it, and if you want to, this is not necessary, but you can look at it, and if you have any questions, let me know. But if you have any questions about any of the chapters, anything in this chapter, feel free to just message me. Thanks.